Hey everyone, thanks for tuning in to our June 2026 Investment Committee Update. I'm Chad Smith, one of the managing partners at Reveille Wealth Management and part of our investment committee. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. Markets became healthier beneath the surface in June. While the headline U.S. stock market was slightly lower for the month, many more individual companies, especially smaller and mid-sized businesses, performed well. This suggests the market's gains are becoming more broadly distributed, rather than relying on just a handful of the large technology companies. Artificial intelligence remains a major investment theme for the market, but expectations may have become too optimistic. Companies are spending enormous amounts on AI, and while the long-term potential remains significant, the committee believes investors should be mindful that not every company making large AI investments will ultimately see strong returns. Global investment opportunities continue to look attractive. International and emerging market stocks remain in positive long-term trends, providing valuable diversification outside the U.S., although a stronger U.S. dollar could create short-term volatility. Interest rates remain an important risk to watch. The committee believes short-term interest rates could remain higher than many investors expect. While bonds have been relatively stable, the team continues to favor investments that are less sensitive to rising interest rates. After strong performance in commodities over the past year, the committee reduced exposure to commodities broadly to lock in profits and modestly increase cash reserves. Otherwise, portfolios remain broadly invested across stocks, bonds, real estate, and international markets. The overall investment outlook remains constructive. Despite some near-term risks, including interest rates and the U.S. dollar, as well as the AI-related market enthusiasm, the committee continues to see positive long-term trends across most major asset classes and remains committed to a disciplined, diversified investment approach. With that, I'm going to turn it over to Stephen to take us through this month's review.
Okay, thank you so much. Thank you, everybody, for joining us. Hope everybody had a fantastic Independence Day holiday. Happy 4th of July to everybody. Let's dive in. And so, as we mentioned in the preview, in June, it was a mixed month for markets, but the majority of U.S. listed stocks were actually higher for the month. And we see that a little bit here where the S&P 500 was down just shy of 2% for the month. The small cap Russell 2000 index was up almost 3%. So this seems to validate the thesis that we've maintained since the turn of the calendar this year, where we laid out some of the fundamental reasons for why small caps would start to outperform in 2026. If you missed that, you can find that video on our YouTube channel. Go to the YouTube, search Reveille Wealth Management, find the video, Is 2026 the year that small cap stocks begin to outperform? You can listen to the catalysts that we were pointing out as potential reasons for why we might see that unfold. Now, global stocks also came under a little bit of pressure in the month of June, likely attributed to a strengthening U.S. dollar that can act as a headwind against foreign assets. Commodity prices broadly fell, mostly due to oil prices retreating on the hopes of a lasting ceasefire agreement between the U.S., Iran, but also Israel and Lebanon. Precious metals have not helped at all. They garnered so much attention earlier this year, but they have seemingly fallen out of favor quite rapidly. Gold prices have fallen almost 30% since January, but that seems a little benign compared to silver, which has fallen over 50% in the same time period. So quite a volatile period for the commodity space as a whole, but in particular the precious metals as of late. The bond market did manage a small gain in June, despite the fact that we've seen shorter-term interest rates begin to rise. Now, this chart here from our friends at Bespoke Investment Group shows the monthly performance differences between the equally weighted and the cap-weighted S&P 500 indices. Now, as we saw on the last slide, the cap-weighted S&P 500 index, it was down a little bit in June, led lower by the large tech stocks that represent a substantial weighting on the index as a whole. But the equally weighted index, as the name suggests, is one where every component is given the same weighting, the same impact within the index. It was actually higher by 2% or so for the month. This represents one of the largest periods of monthly outperformance of the equally weighted index that we've seen in the last 20 years. But I do want to note how volatile this series has become in the last few years. We used to only see meaningful episodes of disparity around major market turning points. But we've also been living in a more rarefied period in the last several years where the S&P 500 index has become very concentrated in just a handful of names. So that's probably why the data points seem to lurch more so between underperformance and outperformance more frequently in recent years versus what it has done historically. Now, we mentioned in the preview that the once vaunted Magnificent Seven index, so Apple, Alphabet, the parent of Google, Amazon, Meta, the parent of Facebook, Microsoft, Nvidia, Tesla, the termed Mag 7, have really turned into the Lag 7 so far in 2026. I don't think anybody should really be surprised by this. The valuations of these names that they got to, the expectations of the future earnings got to be so high that the air was bound to come out of that balloon some. But they're not even really down that much. They're down about 3% or so year to date as a group, and a lot of that is mostly attributed to Microsoft. It's fallen over 20%. But there has become a significant divergence between many of the so-called Mag 7 names, most of which are considered hyperscalers, or companies that are heavily investing in AI. You could also add Oracle to this list. The hyperscalers are the major check writers today, spending hundreds of billions of dollars on AI buildouts, largely without knowing how profitable these investments are going to be. The receivers of these checks, on the other hand, are mostly semiconductor, hardware, or memory chip makers. So you could put Nvidia in there for sure, but the Intels of the world, Microns, Qualcomms, Dells, they're the ones that are selling the proverbial picks and shovels in the AI gold rush. Now, one of the biggest allures to owning some of these large technology names over the last decade or so was the idea that, unlike during the tech bubble of the late 90s and early 2000, where these tech companies, they formerly had no earnings, they had just revenue. More recently, these companies were highly profitable. They enjoyed significant revenue, growth in revenue, all against very small capital expenditures. They were considered asset-light businesses. But that's not the case anymore. These companies now have almost zero free cash flow because they are investing hundreds of billions of dollars in AI without knowing, again, what the return is going to be on that investment. Now, there is one notable exception to this rule from within the Mag 7 cohort, and that is not on this hyperscaler list. And one day it's sure to be a topic of many a Harvard Business School study. Apple has intentionally chosen not to invest billions upon billions of dollars in AI. All of their so-called competition believes that there are going to be significant first mover advantages, and they want to be leaders in the space, where Apple has effectively decided to take more of a wait and see approach, believing that they can quickly piggyback on others' success should they arrive at it, and then they're just going to be able to integrate it into their platform. So the million-dollar question is going to be, is this moment in time for Apple, is this going to be a Kodak moment for them, where they've chosen not to invest in a new technology like digital photography was for Kodak, where they pass on it and it ends up being the undoing of the company? Or is it going to be a story where Apple, unlike their contemporaries, they've had the wisdom to say we're not going to do this because we don't think it actually is going to add value to our platform. So time will certainly tell. Last slide here on the AI revolution before we move on. So this chart made the rounds on social media this month where they were approximating the percentage of US GDP spending that was being plowed into these societal changing technologies or advances. And so I'm really blown away at how much the AI spend seems to dwarf the prior investments that were made in railroads, automobiles, even the telephone. Now, we obviously don't know where this chart is going in the future, but I think investors, especially those that are chasing some of the semiconductor and memory chip stocks, they need to consider that we may be very near peak earnings for those names. And consider this scenario. What if these hyperscalers, if they don't come close to recognizing the returns on investment that they anticipate making on their AI spend? Now, we've discussed previously in other reviews how companies like OpenAI, which still hopes to go public sometime in 2026, they continue to lose billions and billions of dollars each year, and they don't expect to achieve any profitability until at least 2030. So how much longer do all of these companies continue to withstand losing money before they begin to pull the plug? If the hyperscalers effectively end up burning hundreds of billions of dollars fruitlessly, the market probably doesn't like that. But if they decide they can't continue in good conscience with their current CapEx budget because it's not showing return on investment, then the gravy chain for the check receivers goes away almost overnight. Now, the market seems to anticipate currently that these revenues are going to be there for these companies far into the future. And it seems very similar to the expectations that they once imputed on these vaccine makers, that they were going to have sustained earnings after COVID. How did that work out for those companies? In a word, poorly. Is it going to be different or the same? Time's going to tell. All right, let's move on. We're going to turn our attention to the bond market here. Kevin Warsh has been now sworn in as the new chair of the Federal Reserve. And while many pundits have expected that we're going to continue to see interest rate declines in 2026, we have really been outspoken in our disagreement there. The yield on the front end of the Treasury curve has been on the rise since the early part of this year. And the rate on that 12-month Treasury bill, in our opinion, is the best indication of where Fed policy is likely headed within the next year. So with this yield currently clocking in near 4%, we should be anticipating a rate hike within the next year or less. Now, if we start to see it creep up towards 4.12 to 4.15, that would be a hint that a second interest rate increase would be on the table. I can't imagine what President Trump was going to have to say about this when it would come to pass. My guess is it's not going to come from a list of superlatives when it comes to Mr. Warsh. Now, we mentioned that short-term interest rates are on the rise, which is not great, but ironically, longer-term interest rates have actually declined some. The yield on the 10-year U.S. Treasury reached 4.7% in May, but it's down to around 4.40 at the end of June. The yield curve is flattening. That is a move in the right direction for home buyers, as mortgage rates have come down some, but perhaps not enough yet. Now, this could also be suggesting that the current spike in inflation rates that we're witnessing right now are going to be temporary, dare I say transitory. But I do want to be watching this ratio between the 2-year, or the yield on the 10-year minus the yield on the 2-year Treasury very closely. And I suspect that we're going to be hearing about this more in the financial media as time goes on. If this ratio gets back down closer to zero, if it continues to pull back down in here, and if it were to break that an invert where shorter term interest rates would be higher than longer term interest rates. We need to be open to the idea that we could be headed for a recession, which, while that might be bad news for stocks, it's probably not bad news for bonds. So stay tuned. We want to see what information we can get from the bond market there. Last macro theme, it's the US dollar index. And I covered this on the June 25th episode of the $1 Million Question. A strengthening US dollar is often consistent with a risk-off theme in the market. So we saw that in the summer of 2014, saw it throughout 2022, post-election 2024. A weakening US dollar generally promotes the opposite. It's risk on. But so we are finding ourselves currently at a pivotal level here that's acted as support and resistance for the last decade. If the US dollar index trades and sustains above 101, then we might see some more volatility emerge in risk assets like stocks. Now, if we see that this level turns into resistance and the US dollar fails here and starts to move back lower, then perhaps we might experience a more supportive backdrop for risk assets. So we're going to jump into some of the charts here. S&P 500 index remains in an uptrend off of those lows from March and April of this year, but notably, as we mentioned earlier, it did decline in the month of June. Moving on to mid caps, this has been one of the cleaner setups in the market. As long as we're above those former highs from late 2024, we think we should be comfortable owning mid caps. Found support right at those former highs from November of 2024 in March and April, and have bounced higher, up around 3% in the month of June for mid caps. Same story for small caps, only with a longer base. The former highs from November 2024 were the same highs that we originally put in October of 2021, which meant for 5.5 years, the small cap Russell 2000 index made no appreciable gain. And so the index was able to break above those former highs, find support right where it needed to, dug in, and has moved higher over the last several months. As we mentioned previously, Russell 2000 up over 3% in the month of June. Developed international stocks still remain in an uptrend as well, but they also declined in June, down about 1%. Now, this index is still just below its prior high from February, just kind of coiling right here at this point in time. Now, after such a large advance that it had in 2025, it makes sense that it's going to take a break to digest these gains. Now, the recent strength in the US dollar is probably a factor of why it's faced a little bit of resistance here. But if we can get north of these highs from February of this year, this multi-month correction that we've been experiencing here in developed international markets could be coming to a close, and a new leg higher could be on deck. Emerging markets have also been incredibly strong. They were effectively unchanged in June. Now, we've talked about how big of a deal this breakout above the 2007 highs has been. Got a pullback after we broke out back to those former highs in March and April of this year as the conflict in Iran was first getting started. We held at that critical level. That really led to a structural breakout and new all-time highs for emerging markets. But we're now approaching areas, targets, where we might expect to encounter some near-term resistance. Now, while emerging markets are likely in a new structural bull market, so we should expect that we're going to achieve a number of extension levels for this asset class, but we need to understand that this index, it has now become highly correlated with the AI trade, given its exposure to Taiwan Semiconductor, SK Hynix out of Korea. So investors need to be aware of the concentration risk within this index, and they need to manage risk accordingly. So as we get up to those extension levels, rebalancing to target weightings at that point is likely to be warranted. Going to move to commodities here. Now, we've been talking about how these former highs from 2022 were likely to result in some resistance. That appears to be exactly what's taken place. We've been recommending that investors with allocations to commodities pare back some of their exposure to this space as we challenge those former highs. That's been very fortuitous as this asset class has now entered a downtrend. So REITs are in an uptrend and above their former highs from late 2024. While this asset class has been an underperformer relative to the S&P for quite some time, that could be changing. So as the technical picture for REITs continues to improve on an absolute basis, meaning if they're able to sustain above these highs from late 2024, as that continues to improve on an absolute basis, we should look for them to potentially start showing relative strength as well versus the broader market. Lastly, we're going to look at the bond market, which remains in an uptrend after being very close to rolling over in the month of May. With that, I'm going to hand it back for a recap, and then I'll leave us with some final thoughts.
Thanks, Stephen, for taking us through this month's review. To recap, markets were mixed in June, but strength broadened beyond the largest technology stocks, with smaller and mid-sized companies leading the way. Signs of rotation into equally weighted areas of the global equity market and out of the Mag 7 leaders of the past has continued throughout 2026, in line with our thesis at the start of the year. The AI investment theme remains powerful, though rising spending and lofty expectations could lead to increased volatility if future returns on investment fail to meet those expectations. International and emerging markets continue to show encouraging long-term strength, despite some near-term pressure from a stronger U.S. dollar. Interest rates and the U.S. dollar remain key factors to watch, as both could have an important influence on markets in the second half of 2026. Most major asset classes remain in positive long-term trends, although commodities have begun to weaken after a strong run. Overall, the investment outlook remains constructive, with the committee emphasizing diversification, disciplined investing, and risk management amid an evolving market environment. With that, I'm going to turn it over to Stephen for some final thoughts.
Okay, thank you so much, everybody, again for joining us for this June review. Hope you're having a great summer. Hope you had a terrific July 4th holiday. And as always, if you have any questions, don't hesitate to reach out to us. Send us an email to info@reveillewealth.com. Take care, everybody, and we'll see you soon.